Hi, I'd like to speak about a topic that lies at the heart of every international transaction: payment. In international trade, selling products is only half the battle. Getting paid in full, on time, and in the right currency is just as important and often far more complicated than it seems. Why? Because international payments involve distance, differences in regulation, exchange rates, banking systems, and trust. And in some cases, even politics and sanctions. The four main methods of payment. Let me quickly walk you through the four main payment methods used in global trade, each with its own level of risk and control. On advance payment, cash in advance. The buyer pays before the goods are shipped. Lowest risk for the seller, highest risk for the buyer, often used when the buyer is new or in a high-risk country. 2. Open account. The seller ships the goods before receiving payment. High risk for the seller, especially if the buyer delays or defaults. Common between trusted partners or in competitive industries. 3. Documentary collection. Banks act as intermediaries. The seller's bank sends documents to the buyer's bank, which releases them once the buyer pays, DP, or accepts a bill of exchange, DA. Moderate risk, lower cost, but no full guarantee of payment. 4. Letter of credit, LC. A bank guarantee issued on behalf of the buyer. The bank promises to pay the seller once the conditions are met and documents are in order. Secure for both parties, but complex and expensive. Strategic choice, risk management. Choosing a payment method is a strategic decision based on several factors. Level of trust between buyer and seller. Political and economic stability of the buyer's country. Currency risk and exchange controls. Size of the transaction. Competition and negotiation power. For example, a European company exporting medical equipment to a public hospital in a politically unstable country may refuse open account and instead demand a confirmed letter of credit issued by a reputable bank. Beyond the method, other payment risks. Payment is not only about the method, it's also about timing, currency, and enforcement. What if the buyer can't access foreign currency due to capital controls? What if there's a sharp drop in exchange rate between the order and the payment? What happens if the buyer refuses to pay after receiving the goods? These risks are very real, and that's why credit insurance, hedging tools, and strong contract clauses are essential in international deals. To conclude, payment is not just a financial operation. It's a key part of risk management and negotiation strategy in international trade. If you choose the wrong method, you might ship your goods and never see the money. But if you're too strict, you might lose the deal altogether. The key is to balance risk and competitiveness and to understand that the safest deal is the one that actually pays. Thank you.